Tom Hayes, it's great to have you back on the channel, especially in times like today when the Chinese names are under heavy pressure, pretty much everything in red, right? And I think we have to talk about the Chinese economy, but much in particular about Alibaba stock, which I know you are a big Alibaba bull and you know a lot about the company. So I'm very excited to have you here on the channel again. But Tom, maybe you can introduce yourself quickly to the new followers of this channel.
Yeah, well, thank you for having me, Marcel. I'm Tom Hayes. I run a long-short equity strategy for accredited investors and qualified institutions. It's called Great Hill Capital is the name of the firm. We also do a podcast called Hedge Fund Tips with Tom Hayes. It's the #1 ranked podcast in the hedge fund tips category. And you can find that on YouTube, or you can find it anywhere you get your podcast. The benefit of YouTube, obviously, is you get the visual charts, but many people like to listen while they're walking or running or doing other things. And then we have our blog where we publish a research note every Thursday, which is free of charge, and that's hedgefundtips.com. So we're staying busy these days, and we think there's a tremendous amount of opportunity out there.
Right, and a good point of your YouTube is to also get a little insight into your private social life. I always enjoying that. Tom, how are you doing? Are you sleeping at night with having an Alibaba position right now? We've got plenty of negative data coming in, especially these days, right? Today again, yeah, disappointment on the consumer data as well. So how do you stay positive here?
Yeah, no, it's not easy. You just need to put things in perspective. And what I find is to make big money in this business, you have to zoom out. I was looking actually at Alibaba last night, and if you go back to the period from 2015 to 2017, the last time that it took a long time to bottom, it IPO'd out of the gate, around $80. It went up to $120. It crashed down to $57. And then it just literally took a couple years to recover. But once it got through that 100 and then 120, it went straight up to 200 in less than a year. And I think we're going to have a very similar situation. The difference is this time, the consolidation after the 80 or 90% collapse seems to be happening much quicker. It doesn't appear that we're going to need 2 or 2.5 years to form the base. It looks like we're doing it in about a year and a half. If you think the bottom was, give or take the first, if you're into technical analysis, and by the way, we're not, technical analysis only comes in handy when the fundamentals make no sense. And we're going to talk about why the fundamentals make no sense. But, you basically put in that first shoulder in spring of last year. You put in the inverse head, the absolute bottom in the fall. And then you put in the new shoulder earlier this year in the high 70s. And now it looks like it wants to work higher. I think obviously the first resistance has been getting through 100. We did it for a few days successfully. Now it's pulling back to 90. And whether it goes back and retests that shoulder at 80 or 78, we don't know. In some sense, at this stage, we kind of hope it does because we have a lot of new money to put to work, but we're not holding our breath. I think the more likely scenario is that this thing works up to 120, and that'll be the next point at where it's going to hit a wall of resistance. There's going to be a lot of overhead supply. And then once it gets through there, I think it's straight up to 180. So why do we even care about these technicals, and why do we look at them when we say it's so disconnected from the fundamentals? And leaving aside the short-term fundamentals, as you know, that the earnings shot the lights out last week. I mean, it was mind-boggling to consider that you basically have a country that experienced a once-in-a-100-year event, as we all did around the world, COVID, but they prolonged it, self-inflicted gunshot wound by keeping people locked up for 2 years longer than they had to be locked up. And in spite of that, the business continues to grow. It continues to flourish, given it's operating with shackles. Obviously, the shackles are coming off as the government backs off because they don't want 25% of their youth unemployed and rioting on the streets. #1 job of a politician is to stay in power. And I think like COVID, Eventually, people can take pain for so long until they start to revolt. And what we saw was the rioting in December and January, and all of a sudden, overnight, the Chinese government did a 180 and said, "Okay, if you want COVID, have at it." And they reversed their policy, unwelded the doors, let people out of their apartments, and that was that. And I think we're getting close to it on the general social unrest. You don't want a couple 100 million young, educated, angry people without jobs, and that's what they're facing right now. So they're going to have to come out with the stimulus bazooka. And the worse the headlines get, the more bullish it becomes, because we're seeing these piecemeal kind of operations where they say, okay, we'll lower the reserve requirement ratio by 10 basis points or whatever. We'll lower the amount of down payment you have to put on second homes to 40% from 50%. But this is all nonsense. They need to come out with a massive stimulus boost. And I think Kai Fang, who is a member of the policy committee at the People's Bank of China, had it right when he came out and said, look, you need to do $500 billion and you need to put it directly in consumers' pockets, just like the US did and Europe did, et cetera.
Lots of things to dissect here. The first thing regarding youth unemployment, because you just spoke about it, and today we had the news that China stopped basically reporting it, right? I found this quite interesting, because even as a China bull, which I am as well, I thought like, wow, this isn't great in terms of how this will be taken up by investors in order to get a better sentiment and confidence, right? What's your take on that?
Yeah, I think it's like Banana Republic tactics. But the good news is that they realize that there's a problem, and now the question is they're going to have to fix the problem. And I always give people the benefit of the doubt. I have this unreasonable view that people do what's in their self-interest, and in the case of Xi Jinping, it's in his self-interest to avoid unrest and possibly avoid riots and people in the street calling for his removal. And I think I would have figured he learned that lesson from COVID when they started rioting in the streets and he had to reverse his policy. And on that basis, I thought, well, on this, he probably learned something 6 months ago, so maybe he'll be proactive this time versus reactive. It appears that he's not. So on that basis, I think you're going to start to see rioting in the streets. I mean, the Chinese people are smart. They know that he's removing the numbers for a reason. He's trying to cover up a complete failure in leadership. And eventually they're going to take to the streets, because the last thing you want to do after graduating university and having this hope and dream of working for Alibaba or working for Tencent and living an upper middle class life is the government saying, oh, just be pleased with a garbage job, or don't have a job, et cetera. And the government's activity of taking the shackles off of big tech, because they desperately know they now need them to employ these young people, is simply too slow. They're going to have to step on the gas. They're going to have to put it in fifth gear, and they're going to have to hit the nitrous oxide to get this machine going. And I think it's going to be an overnight thing. So for everyone, selling me their Alibaba shares today and other Chinese shares today, I'm very happy for that. But just know that you're going to wake up one morning, just like what happened with COVID, and there's going to be some huge fiscal stimulus or some big announcement. And some of these stocks are going to be up $20, $30, and you're just not going to be able to get in, and they're not going to stop. We don't know when that is, whether it's another year from now or another day from now. But we do know that what we own, okay? And the big analogy I use with a company like Alibaba, which, we saw Taobao and Tmall in the worst conditions in a century, up 12% year on year. Growth is back. We saw the international up 41%. We saw the rest of it up 14%. We even saw the cloud growth, which is going to be the future of the company, up 4%. People were kind of pessimistic on that. But they're still working off. TikTok was their largest client, and they're transferring everything over to Oracle in order to stay in the US. So that's a big hit. But their financial spend from financials is going up, from education is going up, from everything else is going up. And we haven't even gotten into the biggest part of the future growth story, which is large language models, and compute power demand is going to literally be unlimited. moving forward. And we're going to get that spun out to shareholders. So that'll be a standalone basis that can get a standalone multiple. And rather than trading at 11 times versus its historic multiple of 22 times, we'll have a business that can trade at an unreasonably high multiple on the basis of future growth. So that's that. But under the surface, it's like, how can we have confidence when the thing vacillates? Look, we bought some a lot higher than here. We bought some a lot lower than here. Our last purchase in size was at $61. We have purchases at $120 plus. But at the end of the day, it's when you think about what the sum of the parts of this business is worth, and why would we have such a level of confidence? In our conservative analysis, whether it's 3 years out or 5 years out or 2 years out, we think this is worth 280 to 320 when you add all the pieces back, and it could be worth a lot more if we get aggressive. And why we feel that way is not based on emotion, it's based on data. And the one thing that we saw since 2014 is you had revenues per share and cash flow per share up 500% each. Revenues per share up 800%, earnings and cash flow up 500%, and the stock price has done nothing. I've only seen one instance of this in history where it's been such a prolonged increase in intrinsic value without an increase in price appreciation, and that was Microsoft did the exact same thing from 2006 to 2013. When they doubled their revenues, they grew their cash flow per share by 200% and their earnings per share by 120%. The stock price did nothing, but in the subsequent 7 years, it was up 1,500%. Not because the performance went up in the subsequent 7 years. It actually did about the same thing, but because it's pushing the beach ball underwater. You can only hold the ball underwater until that once you let go, the intrinsic value is realized. And when it comes all at once. And Alibaba will be no different. The difference is they've grown the intrinsic value orders of magnitude greater than Microsoft did over that 7-year period. And when this thing goes, no one's going to be able to catch up. And there are a few smart people joining the Alibaba train, as we saw in the public filings last night. David Tepper is one of the best in the business. A huge history of buying things when others aren't interested. He dramatically increased his position, as did Dan Loeb. Between the two of them, they now own $617 million of shares. So it's nothing to shake a stick at. I think with Loeb, it's call it a 4% position. And I think with Tepper, it's a 6 or 7% position. So it's material.
Wow, yeah. The sentiment or the reply and feedback that I get on social media or in my investors groups, for example, my Patreon, is that everybody sees those numbers and saying that, but still the share price doesn't go up, just the other way around. So what do you respond to those?
Yeah, everyone saw the numbers for Microsoft from 2006 to 2013, and no one could figure it out, and everyone was buying them. Everyone saw the numbers in 1998 to 2002 when Buffett was buying value stocks, and everyone was saying he's lost his touch and he's an old man and he doesn't know any better. And then in 2000 to 2002, when everyone got shellacked and was down 80, 90%, he was up 50, 60, 70% a year. So I think what it comes down to is the simple maximum in the short term. The market is a voting machine, and in the long term, it's a weighing machine. In the short term, all the feedback you're getting, Marcel, is on the basis of emotion and people day trading or going on leverage or doing stupid things. But in the long term, if you own a piece of a business and you know that the underlying business is appreciating, it's just a question of waiting. And sometimes playing golf. I don't know if you remember, I did that interview with the CIO of Legatum and the two guys from Sovereign, Chris and Richard Chandler, who took $20 million and turned it into $5 billion over 2 decades. And they would buy these type of things, when groups were dramatically out of favor, whether it was Russia in the 90s or Brazil or Japanese banks in the 2000s. And, they would buy huge positions. Sometimes they would go 50% against them before they went up 3 and 4x. And what they did while they were waiting was, number one, no leverage. So they didn't care how long it took. And number two, in the case of Richard Chandler, he would go out and play golf and learn to speak Italian and take his mind off of it. Because if you owned a couple hundred apartment buildings, Marcel, and they were worth, maybe you paid $30 million for them 10 years ago. But over the last 10 years, the rents went from, call it 10 million a year to, and I'm just cuffing numbers here, but 10 million a year to 80 million a year. And people were still offering you $30 million to buy your apartments. Would you sell them?
Yeah, no.
But that's exactly what's happening with Alibaba right now. That's the thing is that revenues are up 800%, and it's trading at the same price that it did some 8 years ago. And all you can do in those type of situations is just say, and more important than anything else is the free cash flow. Alibaba generated $25 billion of free cash flow. Their cash flow this quarter alone was up 76% year on year. This is usually a weak quarter. They did over $5.4 billion of free cash flow. And people are wondering, is the business okay? I mean, is the business okay? In theory, in actuality, it's better than ever. And in reality, wait till the stimulus comes and wait till things normalize. They just opened the country from COVID 6-7 months ago. It takes a little time to get some momentum. They haven't put money in the consumers' pockets yet. We think that's going to be forced to come. And I think Brendan Ahern said something very interesting a couple of days ago. He said that the Shanghai Composite at 3,200 and the Shenzhen at 2,000 has been when policy support has been aggressively announced in the past. So again, you could wake up tomorrow, you could wake up a year from now, but it's coming. And the key is your apartment buildings continue to grow their revenue. They continue to grow their cash flow. So the only question is, when is someone going to offer you $240 million for that apartment package that you paid $30 million for 8 years ago?
Right. Before we talk about your expectations of the coming stimulus, or we can debate whether or not this is coming, I want to know from you which camp you're in currently regarding the more macro views on China, like the economic data is coming out. Are you in the camp that it's really bad and that's why we need the stimulus? Or do you think maybe there's also a little bit of exaggeration and focus on the negative points when it comes to the media bias? Where are you here? Where do you think is the truth?
It's interesting. I'm not a big conspiracy theorist, but I will say the media bias is unbelievable. I mean, I saw articles covering Tepper and Loeb today, and they basically covered every stock in their portfolio except the fact that they both dramatically increased Alibaba. It was kind of mind-boggling to me. If I read the headlines, I mean, it looks like China is going off a cliff and never come back. If I listen to the companies doing business in China, they couldn't be more excited about the last 6 to 8 weeks progress in the country. Like they're saying the consumers coming back in leaps and bounds, whether it's Wyndham, I think it was Wyndham Hotels, whether it's MGM China, whether it's Alibaba itself,
Disney,
Starbucks, it's just the list goes on. And the common denominator is in the last 6 to 8 weeks, things are going straight up. So Yum China. So I continue to be more interested in what the companies have to say than what the headlines about, biases towards particular region. And look, there's reason for biases. I mean, there are problems, there are leadership problems. There are a lot of mistakes made. The problem is the machine is so big, even though they're working they worked 24/7 to kill it 2 years ago. They couldn't kill the machine. It's just too strong. And I think that's going to persist. And it's certainly going to persist. Our base case is for certain for the next 3 to 6 years. I think we're going to have one more parabolic run in China. And then I do believe all the theses that China will be the next Japan, in the sense that they do face an aging population. They're not having babies. They don't have immigration. But historically, if you look back over the last 100 years, what you're going to find is that all the countries that had a large portion of their population between 30 and 40 always had very strong economies and very strong stock markets as a result throughout the last 100 years. You can't find an instance to disprove it, meaning I defy you to find me a situation where the country had the largest portion of their population, aged 33 to 40, and the economy and stock market didn't go straight up. So we have that situation in the US, but they also actually have it in China. They've got certainly the older group, but the echo boom, like we have in the US, we call it the millennials. So the Chinese millennials are average, 33 to 36, which implies, based on housing formation, family formation, consumption years, earning in those years, that the vast majority of the spending in one's life happens in that period from 33 to 40. That drives the bus. And then I think after that, they're going to have a real demographic problem, and they'll probably go through a lost decade or two like China did. But in the meantime, when the music's playing, you got to dance.
Or Alibaba solves all the problems and issues with artificial intelligence. That would be also a good case.
Exactly.
What do you make about those issues in the real estate sector? We've now have the, I think, #2 in China real estate defaulting, which is quite unsettling some of the investors lately. And hopping over to also the yields and the US dollar strength, did this surprise you that we still don't see those big indicators tumbling over and reversing back down?
Yeah, so I can't remember a time in the last 10 years that China didn't have a big real estate problem. So maybe this time is different. But I wouldn't hold my breath. What we've often found is that China has a real estate problem. Real estate problem gets ignored. Problem happens. Government says, okay, we got it contained. Problem's not contained. New real estate problem emerges. Government panics, does massive stimulus, and we're off to the races. So I think we're close to the latter part of that story that continues to replay on autopilot. So the worse the headline gets, the quicker they're going to act. And I think that's where we're at. We're right at an acute phase. What I can't figure out is whether Xi is going to require 2 million young kids to go on the street and call for his head before he actually shoots the bazooka. Whether he's intelligent enough to do it proactively, or he's going to have to do it reactively like he did with COVID. That's the only issue at play. And the second question you had was...
that quite recently the yields were still rising.
About the US dollar. Yeah. US dollar and yields. Yeah, I think this is kind of the final blow off. I mean, we're at or near the end of the Fed's tightening policy. More and more people are predicting that there will be cuts in the first half of next year. I'm not so certain about that, but what I am pretty clear about is that they have all the cover they need to get out of the way. And even though our rates are high, the key is we're going to be stopping our tightening process before all of our peers. So on a relative basis, we've had this counter trend bounce in the US dollar after collapsing since October, which, as you know, we were very vocal publicly in October that the dollar was going to roll over. Yes. Sure enough, it did. And within months, Alibaba went from 60 to 120, or maybe it was weeks. But once the dollar weakened, so we had a counter trend bounce on the debt ceiling debate, and now we're having a counter trend bounce on this new type of uncertainty. But the end of the day, you got Jackson Hole, and then you've got September. I think in September they'll come out and say we're going to skip again and wait for the data. They'll never say we're done. They'll never declare victory. But more likely than not, they'll say we're done. The dollar can resume its downtrend. I think the big surprise of the second half of this year, which goes completely counter to what everyone is thinking today, with yields blowing out a little bit in the short term, is that the 10-year is going to get bid and yields are going to compress to the low threes. And that's going to be the shock. The dollar weakness, the bid in bonds is going to be the shock. And that's going to be a huge catalyst and growth driver for flows into emerging markets. You just have to keep in mind, it always looks darkest before dawn. Whether it takes 2 years to bottom out like it did from 2015 to 2017 before it went straight up in 9 months, I don't think it's going to take quite that long. I think we're kind of there, and now we just have to determine in terms of sentiment and emotional voting machine in the short term. Do we go back into the 80s before we shoot up to 100, then 120, then we'll rest up there and then up to 180? Is that all going to happen before the end of the year? I think it's possible. Or is it going to take another 6 months? And that's just going to be dependent on if is Xi proactive? If Xi is proactive, then we're going to be off to the races. Or is he reactive? Then it's a question of when did 2 million kids go in the street and call for his resignation, like we started to see in COVID. And I think we're there, because the last thing you want as a leader of any country is angry, educated young people with a lot of energy in the streets. Nothing good happens, and I think they realize that, and I think they're praying they don't have to do the bazooka, but I think all things point toward it, with the real estate issues that you pointed to. But I also think that the surprise, when you listen to business by business and how they're doing, is that I think the surprise at the end of this year is, it's going to shock people, is that China does end up exceeding 5% GDP. And everyone's going to say, how the hell did that happen? I thought things were so bad. Well, listen to the companies, listen to what's actually happening in the business, avoid the headlines, and follow the smart money. It's nice to see it. It was a little lonely. No one wanted to touch it down there with us at 61 and 78 and all those areas that were just like, hang in there, ladies and gentlemen. Your building is still growing rents. Don't sell the building at a low price. It's worth 8 times, 5 times more. And then, it goes straight up, and then everyone chases it on leverage after 100% run. They get their faces ripped off. And, the answer is just own a high quality business and wait. You can't control when it's going to happen, but if you've done your work and you understand the intrinsic value and the business is unimpaired, or in the case of last year, it was temporarily impaired for a few minutes because of the crackdown, and you could look through that and understand that ultimately the government does what's in their best interest, even if they exhaust all other possibilities first. Then you can step in when it's a little noisy and a little bit emotional, like it is right now.
It seems like everybody is kind of really waiting for this trigger of stimulus, right? So let's be a little bit more specific about, for example, your personal expectations and which area, because, for example, I'm a little bit skeptical, to be honest, like if it will be, the kind of stimulus that we are all waiting for. I think China currently, first of all, thinks that it's not as bad as many describe it out there. And second of all, I think they are not going back to the old growth model of, for example, helping out real estate or just, getting growth. You just mentioned it. It's, by the way, around 30% of the world growth, right? Around 12 trillion, I guess. So I think China's not going to go back to this model and just building more houses in order to show those growth figures. I think it's going more into new initiatives, into technology. I think Alibaba will also benefit from that. But help us understand, like, what signals are you waiting for? Like, when would you say, now this is the stimulus that we've waited for? Or maybe investors, maybe you can speak on behalf of general investors.
That's a great question. It looks like they continue to pound the drum on they want to foster consumption. They want to be a consumption-based society like America is. The question is whether they will be able to. They've got to put their money where their mouth is. I mean, it's interesting. I always kind of thought China was a bit smarter in how they handled stimulus, in that by investing in infrastructure, the money they spent would have a short-term benefit to the economy, but then they would have a long-term asset to benefit society, whether it's a bridge, whether it's a road. I guess ghost cities aren't very useful to society, but maybe they are if you look 5 years out as more and more people come in from the farms and their middle class grows, et cetera. But I think COVID is a different type of problem, and that they're treating with maybe the wrong medicine. And I think the medicine required to spur consumer confidence was actually what the US did, which was architected by maybe the greatest public servant that we've ever had in the United States, which was Stephen Mnuchin. A lot of credit is given to the Fed, but Mnuchin was the architect and the person who devised it and executed and guided the Fed on what to do during those dark days in March and April of 2020. And I think maybe they'd be well served. They're very good at copying technology. They might be well served to copy stimulus and recovery policies that actually work versus dithering around and kind of wasting time hoping things are going to get better quickly, and really risking massive social unrest. Because with 1,200,000,000 people, if you get 10% upset and out on the streets, it's over. You're out of power. And these things can turn. Oh, I mean, if I was Xi, I would be extremely scared. And I would be pumping cash out like there's no tomorrow. I'd be putting it right in their pockets. I'd be listening to this guy. As a matter of fact, I would take Xi Feng's idea and give him some credit for it, put $500 billion in people's pockets. And if it didn't work, just fire him and make him the scapegoat. I mean, it's like asymmetric benefit. If it works, you take the credit. If it doesn't work, you fire him and you stay in power. I mean, I don't know what there is to think about. Plus, they have zero inflation. It'd be one thing if they were running inflation at 15%. The last thing they want to do is print $500 billion. But their major risk is actually deflation. So they have all of the wiggle room to go massive into this. And what I always say is, you can only control the process. You can't control the outcome, which is why we don't own one company. I mean, in theory, all things held equal, I've never seen a better value per dollar with a moat of a business than I see in Alibaba. But so if I was 100% certain, why wouldn't we just be 100% in Alibaba, or leverage one time and 200% in Alibaba and forget the rest? Because you can't control the timing. You can only control the process. So if I've got 8 to 12 great companies that are all increasing intrinsic value, increasing cash flow per share, increasing in earnings per share, increasing revenue per share, growing their moat on their business, some are going to pop overnight. Like we've got this one company, Cooper Standard, which was a special situation that was up 4x within 12 months. Okay, so that's really good. But it's the same process as I use to be in Alibaba, which may be up 3x in 3 years when all is said and done, or 4x in 3.5 years or 4 years. The only difference is going to be the IRR. But the key is the process works. If the business keeps growing and the price stays same, eventually the price will catch up to the intrinsic value. And that's our model. The difference is some people are impatient. Some people go on leverage and they get blown out. And the ones who are patient wind up being the David Teppers and the Dan Loebs of the world, who get it right and have patience and get the best companies when they're on sale and make a lot of money for their investors.
Right. Maybe a personal question, because as I mentioned, you also always speak about your social life on your YouTube channel, which is great. And I'm just wondering, like, you're out there pretty alone, like pounding the table for Alibaba, sometimes Chinese equities and so on. Must be pretty lonely, and it's getting very political, right? So what do you say to those who say, like, well, there's no way American investors will touch Chinese equities again, or Wall Street coming back into the sector? Do you get this question sometimes?
Yeah, opinion follows trend. I mean, they won't touch it until the price goes up. And then when the price goes up, they'll start to get fear of loss, and then the price will go up some more. And at around $180 or $200, they'll all start to get interested but skeptical, be waiting for a pullback that never comes. And then around $250 on every single talk show, every single analyst you're going to see on TV every day of the week is going to be talking about the Alibaba's the greatest thing in the future. And after it's already up 300%, they're going to be talking about how this could be a multi-bagger over the next few years. And it'll be that time period when everyone's super excited between 250 and 300, and they all can't get enough of it, that will be helping them out and laying off some of our shares. And that's the way it works every single time. They won't invest in, there's actually one that is has been very, very, very outspoken on Alibaba, a public figurehead, particularly when it was at $60 last year, couldn't hate it enough. And now at $100, he's starting to buy it. So why is he buying it? Because a big name guy is in it that he likes and respects. So they all follow. It's all a herd. It's a herd to the downside. It's a herd to the upside. The game is just getting started. What will be the most fun is when we're back up at $120 and you have all the pessimists that are going out, and they'll tell you it's going right back down to 60. And once you get consensus that it's going down to 60 is when we go straight to 180 and leave them in the dust. And by 180, those exact same names will come on and say, we just started building a position. We feel very comfortable about the future prospects. We think it can be a $500 stock, yada, yada, yada. I mean, history doesn't repeat, but it rhymes. So with all the pessimism about how you can't invest in China, just wait till it's up 50 points. All of a sudden, that'll be rear view mirror. People will forget it, and they'll all be chasing like the herd because of FOMO. And then, you know, hopefully a few of them will actually understand the fundamentals and realize the true potential of the business.
Okay, I don't want to take up too much of your time. It's great to have you and all of these insights, but I want to give you a little bit more chance to go more in specific of Alibaba and talk more in detail here with my last question, which is about, it seems that this company is also quite hard to understand for investors because it's simply so big, right? And Alibaba has now just started to split up a little bit, and maybe that's also confusing investors on top of that. So do you think there is an issue with fundamentally analyzing and understanding this company, and maybe that's also what's suppressing the value in a sense? Because, for example, how do you ascribe a value to the cloud business right now and to the AI opportunity in China and so on? How do you do it? And do you think that's an issue?
Yeah, I think that's a great question. I think the more noise is about Xi and his policies than it is about the business. Because if you can understand it, if you can understand Amazon in the United States, you can understand Alibaba in China. The only difference is, you know, Amazon's trading at 60 or 80 times earnings, which, by the way, we own Amazon for similar reasons to what we own Alibaba. We just were buying it in the fall when no one wanted it. Now everyone wants it. It's probably going to pull back a little bit, but we're not going to do anything because we own it for the long term. But as it relates to Alibaba, it's trading at 11 times forward when it's historically traded at 23 times forward, and it's trading at 11 times forward of depressed earnings expectations and depressed cash flow. So, you know, if you look at the McKinseys of the world, when they talk about the cloud computing opportunity in China, and they say it's going to triple by 2025, you know, even if they're off by a year, Alibaba's got 38% share. You got a lot of knuckleheads on Twitter saying, "Oh, Alibaba's losing share." Number one, you're missing the point. If you're worried about share, your view, number one, they're not losing share. But number two, if you're worried about share, you're thinking that it's a fixed pie. And the point is that the pie is going to get 3 times bigger, and it may be exponentially bigger, much bigger than you or I could even imagine when you consider the compute power demand being unlimited as these large language models. And then you got, and Alibaba's in a position, they're going to get everyone on it at very low margins and then sell them all of the AI overlays where the margins are, you know, basically 100%, and sell them all these services. So I think what's hard to understand about Alibaba relative to AWS is when you look at China being about 5 years behind the US in terms of digitization of their businesses, and you look at the AWS model from 2016 to 2021, you know, Ali Cloud is basically where AWS was in 2016. So just following that trajectory, Alibaba will have another $10 billion of operating income over the next 3 to 5 years just from the cloud. And that's 10 billion over and above what they had several years ago when the stock was trading at $320. So if you have 60% more operating income than when the stock was trading at its peak. But the problem with that analysis is that AWS did not have the growth opportunity of AI and all the unlimited compute power of the large language model, generative AI, et cetera, that Ali Cloud has prospectively. So we may be underestimating the opportunity of AWS on a of Ali Cloud on a go forward basis. And by the way, of AWS as well, but we're not here to talk about Amazon today. But certainly for Ali Cloud, which will be on a standalone basis, and that multiple is going to be very aggressive as this thing goes and as it starts to take off and hit on all cylinders. So, you know, we are where we are. We're in a holding pattern. We're waiting for a couple catalysts. What are the catalysts? Number one, emerging markets need to work. How do emerging markets work? Fed gets out of the way, dollar goes weaker. Once that happens, you get the flows. Once you get the flows, you get some price appreciation. Once you get price appreciation, you get analysts paying attention. then analysts actually start to look at the business versus the headlines. Then you get some catalyst from China on stimulus, because sooner or later this is coming to a head. I think we're right at the head, just like I thought we were in December and January with COVID. I said people aren't going to take this anymore, and
Yep.
Sure enough, we had the riots in the streets, and you walk up, and the comical thing was, you walk up, COVID's over, and we're all thinking, God, is he going to weld them back in their apartment next week, or is he actually going to let them stay? And then 3 weeks later, oh, there's a COVID wave, and all of us idiots in the West were like, okay, in 3 months there's going to be the second COVID wave. There was one COVID wave, and that was it. COVID was over. They've got no vaccine, no real vaccines, and somehow miraculously COVID was over in 3 weeks. And they wasted 3 years locking them up in apartments. They could have done this 3 years ago. But leaving that aside, there are always political considerations and timing, and the timing that he had last November, et cetera. But I think all of that's in the rearview mirror, and I think this is kind of the last test and the last opportunity for those who aren't positioned, and then we start to focus back on fundamentals. So it's going to take price moving up, and price moving up is going to be a function of the dollar, function of the Fed, function of wholesale flows into emerging markets, which is certainly the back half of the year story in our view. And then some policy tailwinds from the Chinese government, which they'll have to do whether they want to or not. And then these businesses continue to execute on all cylinders, whether it's Nike or Win or MGM China or all the others, or Yum China talking about how great the business has been in China the last 8 weeks, or Alibaba themselves with the earnings. This is just the beginning, and I think more of that will be realized as Alibaba breaks up into the 6 parts, and you start to get good valuations for each part of the business. Mm-hmm. But none of that happens until you get the wholesale flows into emerging markets, which is China. That's a function of the dollar and the Fed. That's an imminent thing in coming weeks. Then you get a little tailwind from the Chinese government. Then you get some focus on the fundamentals. Then you get the analysts going. Then you get the FOMO, and all the people who wouldn't buy it at 60 are now, begging to buy it at 120. Then you get a pullback to shake all those weak sisters out, and then we start to make our way to back to 180 and beyond. And then you get all of the most negative people at 60 and 100 that can't get enough at 250. And then we'll be doing this, and I'm going to be talking. Everyone's going to be super exuberant. All the Twitter is going to be China, China, China. And I'll be on and say, yeah, we just sold 20% of our position. You're going to be like, what? You're Mr. Alibaba. Like, how did you sell 20% of your position? I was like, well, it's 280. It's fairly valued. We'll hold the other 80% until people get super exuberant. But, that's where we are now. And we'll go back to this video in a couple of years, and we'll be like, I can't believe. And I'll say, what do you mean you can't believe? Of course you can believe. If you own the apartment and the rents went up 800%, you would have never sold at $100. And that's exactly what we're talking about here.
So good to hearing this from you, Tom, because I fully agree with that. But maybe one more question, if you have the time, regarding your AI opportunity for Alibaba, because investors would say, well, yeah, we see the potential. However, there is also the US Chips Act, which basically limits some of the exports of the most powerful chips. So what makes you believe that they can really execute operationally on this opportunity? Do you have some thoughts on that?
Yeah, that's a great question, by the way. There was an expert on, I'm trying to think who it was, but he basically said they have all of the chips they need to, number one. And number two, the unintended consequence of this CHIPS Act is it's gotten all of the Chinese chip makers accelerated and supported by the government to replicate them sooner rather than later. And even if they can only replicate 70% of the value of what we get from NVIDIA or soon to be Intel or others, it's more than enough. They'll basically just need more of them to have comparable performance. But at the end of the day, or even if they're modestly slower, they can still perform the same basic activities, even if it takes a hair longer or slower, assuming that they won't be able to gain access to the technology. And I would never count the Chinese out from being able to get their hands on it and reverse engineer it, because they've proven over and over they know they can figure out a way to do that. But assuming that the US government is right and doing these sanctions is going to be effective, keep in mind the Chinese government is not going to allow US competitors to take all of their domestic Chinese cloud business. They don't want the US providers in there. So, in the kingdom of the blind, the one-eyed man is king. If Ali Cloud runs at 80 or 85% efficacy to AWS, but Ali Cloud is the only one you can use in China, they're going to get 100% of the business, right? So I think it's on a relative basis. Even if the product is only 90% as good as the US version because of the chips, which I don't think will be the case, but assuming it is, if all you can buy, if that's the best that you're allowed to buy where you are, that's the one that you're going to use. And I think Alibaba is going to be the key beneficiary of the trend in that direction. And again, we continue to focus on AI, but if you look at the AWS trajectory and the digitization trends, leaving AI aside, which is the hyper-growth opportunity moving forward, they still have so much catch up in the basic cloud computing services.
Tom, thanks so much for coming on the channel again. I'm pretty sure we go back, as you said, and watch this video and see like everything you said turned out the way it has, because that's what happened last time as well. So I'm happy that you took the time again. Tell our viewers again where to find you, and then I hope to hear again from you very soon.
Yeah, well, first off, I want to thank you. And you and I go back now sometime, and we've enjoyed this bottoming process for the last year plus. I will say you have a very special audience and a very special channel that you've built, and you deliver a lot of value to your listeners. Anytime I go on with you, the engagement and the interest of your group and the activity of your group around it is just superlative, and seen very few other places. So you've built a bond, and you've built a tremendously independent thinking audience who are willing to look outside what is being fed to the herd and think for themselves. And I think that's a very valuable service that you're providing to people, and it's reflected in the growth. So the best way to reach me is on Twitter. The handle is @hedgefundtips.com. The website for the weekly research is hedgefundtips.com. And also you can go to YouTube and just type in Hedge Fund Tips, and you'll find Hedge Fund Tips with Tom Hayes, our weekly video cast, or go to wherever you get podcasts and put in Hedge Fund Tips with Tom Hayes. Very grateful to be here. Always a pleasure, Marcel. Thanks for having me.
Thanks again, Tom, and have a good one.